Good morning, everybody, and thank you for joining us this morning for our webinar. It's hard to believe that the end of 2020 is almost in sight, and that it would appear that we're starting to see the first signs of at least the health effects of the pandemic being behind us in South Africa. Unfortunately, the measures taken to achieve that, or that's also a debatable point, of course have left mayhem in terms of our economy. So while on the outside there's tremendous pessimism around our economy, politics, investing, staying invested, this is a time we've used to very actively research and review all investment opportunities. And we think that the current environment is one that is ripe with those opportunities. But I don't want to steal the thunder of Justin Fleur, who's going to be our fund manager of our Balanced Fund, which is going to be leading the discussion today. And he's also being put in the hot seat by Joanne Bainham, who's an independent wealth manager and has over 20 years of fund management experience. And part of that experience involved grilling fund managers. So we hope that today you will enjoy this format of Q&A. And of course, please post questions or any issues you have during the webinar, post it on the chat screen. We will also be taking some of those questions towards the end if we haven't answered them. And do remember we've applied for CPD points, so we will make sure that there's a forum for you to apply for those at the end. So without further ado, I'm going to hand over to Justin and Joanne, and we hope that you enjoy and find that this will be valuable to you and your clients.
Annette, thanks so much for that introduction. And I, for one, am very excited to be here today, especially to grill, I think those are the words you use, Annette, Justin on markets and his funds. Welcome, Justin.
Thanks, Jan.
Okay, so a lot is happening in the market at the moment. COVID for one, the US elections, the debate was an absolute debacle last night, and clearly lots of issues in South Africa as well. How do you see the world currently playing out?
Yeah, it's been a remarkable year. I think a lot has been said by the commentators, so I think I'm going to try and focus on a couple of things which I think are quite important for us in our process. I think the first thing to notice is that it's been a year where human interaction has changed in a very, very substantial way. And Reed Hastings from Netflix had quite an interesting comment in a recent FT interview where he said, we had this completely out of the blue human virus that hit us. And what it's done is the government response to that has substantially changed our human behavior and human dynamics. But it could have been the other way around. It could have been a computer virus. And I think the dynamics we'd be speaking about today would be very different. But the card has been played. It is a human virus, and man, it's had a huge impact here. So I think we all know the stats. I'm not going to repeat them. But I think what's quite interesting to me is the government response. It's been unprecedented, is the word that's, I think, appropriately used. And I think what's quite interesting to me is I think the monetary stimulus side of it is something we reasonably used to. I think the quantum is maybe something new, and I think they've gotten a lot more confident about it, particularly the Fed and Europe. But what's quite interesting for the first time is we're starting to see a very big shift towards fiscal stimulus as well. And this is going to be the first time that we're actually going to see those in parallel in a big, big way. And it's going to have quite interesting implications. Now, I think, as you know, and as many of our audience knows, we're not macro specialists at PSG Asset Management. We like to think as bottom-up as we can. We try to think as business owners would. But at the same time, we try to be macro aware. And I think this is an important question. And our sense is keep an eye on inflation, global inflation, particularly after this first round of deflation as a result of the supply and demand shock kind of subsides. I think you're going to see some interesting inflation dynamics globally. And that's going to have interesting implications. And we don't know the answers yet, but on things like the dollar, and on emerging market cycles and that type of thing. So I think the landscape's quite interesting over the next couple of years. I think that's the one side. The other side is just to reflect on, it's been really a world of two very, very different markets. On On the one hand, and again to use this phrase, human impacted and technology impacted, the human impacted side has had a very tough time. There's natural connections which result in kind of normal commerce and trade have been severed temporarily, and that's had a pronounced impact on, obviously, earnings, cash flows, sentiment, and valuations in large parts of the market. Meanwhile, you've got this other part of the market that's been largely immune. In fact, in some cases, have actually had a benefit as people work from home, people use more technology. And that's quite evident in the markets. You see the markets, there's very much a tale of two cities, or a glorious city on the hill and then a bit of a slum, it seems. And I think that in itself is quite interesting to observe. So where we're sitting at the moment is, I think we think the platform is set for a lot of investment opportunity, but I think you've got to be quite careful. It's not a matter of just close your eyes and buy what looks cheap. I think as we'll discuss through this chat, I think you've got to be quite careful about what you're buying. But without a doubt, we think there's a lot of opportunity out there.
You did say you're not macro specialist, but what did you think of the debate last night?
More of a debacle than a debate. I didn't actually watch it. I was fast asleep. But just looking at the comments this morning, it's not amazing. So hopefully our chat today is going to go a bit better.
Okay, hopefully too. So we're in a bifurcated markets. Markets are very currently momentum driven and very narrowly driven. You're not jumping on that bandwagon. Why not?
Yeah, if I can that's a good question, and maybe just point you out to the slide over here. And it's quite an interesting one to just sit back and reflect on a little bit. And what it shows is the percentage of, I think, the most widely followed stock market in the world, the S&P 500, and how much of that stock market is comprised of the top few shares. I think what you're seeing now is probably the most concentrated and narrow market we've ever seen globally. And it's quite an interesting trend because actually this is not just the US we're talking about. It's obviously quite pronounced there. You've got your famous tech stocks kind of at the top there. But actually if you look globally, it's very, very similar. Parts of Asia and then our own exchange as well. You've got Naspers and Prosus, which together make up a similar portion of our index. So on the one hand, that's the one quite interesting thing, and I think it raises a couple of interesting questions. Is what's actually driving markets? And it's clear that it's a handful of very, very well-performing companies that are driving that. And the logical implication of that is actually the rest is largely being left behind. And what that means for us is our process is one that it naturally gravitates towards finding good companies with underappreciated qualities that we can buy at good margins of safety and that are well governed, well managed, and where capital allocation is good. And that's typically not kind of these go in favor stocks. So we're quite excited at the moment. We're seeing a lot of opportunity in areas that are not kind of at the top end of market concentration. We think one of the important things to realize is when you have markets as crowded as they are today, and you can pick the crowding from the passive side. A lot of money has gravitated towards passive, and then naturally they would be crowding into things like this. But even on the active side, and I think what we're seeing for the first time over the last couple of years is a massive retail participation as well. So you're seeing the Robin Hood traders. And that's typically, when we see patterns like this historically, they've always had quite interesting outcomes. So what we would say is be careful of the risks. These are often good companies, but good companies can go too far. And we think there's a lot of opportunity kind of underneath the headlines.
Justin, there was a classic comment from one of the Robin Hood traders when they had a share split. And then they'd saying, oh, the shares are cheaper now. And that's the kind of person you've got investing in markets today. So yes, I totally agree with you. There's a kind of eerie 2000 feel about markets. Interesting also on that chart, China, I think, also has massive concentration risk. So it's not just an S&P issue. But you brought up a very good comment. You said, you're looking at undervalued companies. I look at the S&P and I look at the NASDAQ particularly, and I say to myself, well, markets are expensive now. I don't want to invest. What do you say to that comment to people who say markets are too expensive right now?
Yeah, certainly. I think if you had to imagine yourself as an kind of an alien or a Martian kind of rocking up on the world today, and you look at markets and where they are, and you look at that chart, you'd probably be pretty careful, and you'd probably want to be sitting with a pretty defensive positioning. Then when you look at the PSG asset management funds, you'd probably scratch your head a little bit because that's not how we positioned. We actually have an above average exposure to growth assets today. Now, a key reason to explain why that is perhaps appropriate is this slide here. And what I can draw your attention to here is it just shows you a couple of key markets around the world. And it tells you the percentage of shares that are in bear market territory or more than 20% below their highs. So these shares are not at all-time highs, and they're not the market leaders. And you can see quite a remarkable number of statistics here. One is, you've got some countries that are completely out of favor. South Africa, Japan, more than 80% of the shares are in deep bear markets. And I think we feel
80%.
that. We feel that viscerally in this country. So while indices are high, and they're driven by this very, very narrow part of the market, the rest is actually, it's been a pretty disastrous 5 years. And asset prices are very, very low. And even the US and Europe, which are perhaps more favored, even there, more than half of the companies are actually what we would say in bear markets or have fallen substantially from their highs. So certainly when we look at it, that's just the top-down perspective, but when we're looking at things from a bottom-up perspective, trying to find underappreciated quality, we're seeing there's a lot of opportunity out there. Our buy lists are full. Our funds, as a result, we allocate our cash bottom up, and so our funds have a substantial allocation to growth assets at the moment. Very different growth assets to the ones that are driving markets to all-time highs, but we think assets that will really perform well in the next couple of years.
Given what you've just shared, one could almost say you're spoiled for choice, because there's clearly a lot out there that's in a bear market, which must be fantastic for a fund manager to find.
It brings interesting challenges, and I think it's something we get particularly excited about is when we're sitting trying to allocate capital, and we have this abundance of ideas, and each idea is good. It's excellent in its own right, and we're almost forced to choose the best ones. I think you're in a pretty good place. It's a very different situation to where we were in 2015. 2015, it was quite hard. I mean, we were looking for value, and it was tricky. There was kind of little to go around, and I think things are looking a lot more attractive today, for sure.
So, Justin, you throw those words value, growth in the sentence. Some people in the market see you as value managers. I personally have always seen you more of a quality manager that didn't want to overpay, sort of your 3M process, margin of safety. How do you think, what best describes your investment philosophy? Are you value managers or not?
Yeah, it's an interesting one. No fund manager wants to be put into a box, as you know. I think flexibility is an important attribute and weapon. But I think it's a very important point because it comes down to the core of how we invest and what we do. And if I just draw you back to our 3M process, there's 3 broad pillars that carry a lot of weight in our minds. There's the moat, and that's a function largely of quality. We're looking at competitive advantages that are deep, that are enduring, that we can get behind. And there's always a spectrum. And I think that's the other important thing is you don't get, top end, the top decile of quality, and then everything else is rubbish. There's a spectrum. And I think within that, what we're trying to do is try and figure out what's the appropriate price for each part of that spectrum. So margin of safety becomes incredibly important as well. And then altogether, how those cash flows are stewarded and managed, the management M becomes quite important. So you put that together, the holy grail for us, and we don't always get it right, but this is what we aim to do. The holy grail for us is to buy underappreciated companies that have a high amount of intrinsic quality that the market's missing for whatever reason. And that could be because there's been a temporary setback. Maybe there's some kind of macro noise around it, like we're seeing in South Africa at the moment. It could be that they just misunderstood or misfollowed. In many cases, what we're seeing is there's been an allocation of resources away from the sell side. So actually, typically more and more focus is just on these big shares. And actually, there's very few people and researchers and investors actually looking at some of the more medium-sized shares underneath. So we think that brings us incredible opportunity. So for us, the holy grail is we buy those companies that will be the favorite stocks tomorrow. And a good example is a company like Microsoft. Microsoft came in the chart earlier. This is a stock that was a favorite in the dot-com bubble, fell out of favor. It was always been a good company throughout. It was never a bad company, continued to grow profits nicely. Our funds had a substantial allocation to it 5 or so years ago when it was out of favor, when it was not in the top 5. We don't own any now. So I think hopefully it's a nice way of communicating. We love quality. Give us quality at the right price. When people don't think there's quality, we're in there. And I think we'll chat about some of our top 10 just now. Hopefully we can go there.
Can we see some of your top 10 positions at the moment?
Sure, yeah, there they are.
Okay, so Justin, Anheuser-Busch, you talk about quality. And when I think of quality, I think of rock-solid balance sheets. I certainly don't think that about Anheuser-Busch at the moment. So please explain to me, given your 3M process, with that much leverage, why you're holding it.
We love this question because I think what it highlights is how important it is to think differently and how important it is to do deep, thorough research. And without a doubt, you take a top-down, superficial look. AB InBev has a lot of debt. They overpaid for SAB Miller. They took too much debt as a result of that. There's a mismatch of currency. They got hard currency debt and a big degree of emerging market revenues. And I think many top-down commentators would kind of throw it out with the bathwater, right? So I think what the guys miss is a couple of things. One is when you actually look into the detail and you pick apart how the company has structured that debt. There's some interesting insights. Number one is these guys have taken the opportunity presented to them by this monetary bonanza, and they've been able to fix their debt extremely long. And they were issuing paper out to 30, 40 years. So they've got an extremely long profile, more than most governments. Okay, so that's just one thing to bear in mind. So they've got a lot of debt, but this is like they're 30, 40 years out. This is not a problem in the near term. The other interesting thing they do is they keep the window over the next 5 years of debt obligations and repayments very, very clean and actually pay up for that. So what they do is when bonds start coming closer to maturity, they actually pay up to redeem those bonds and issue them long again. So they're always keeping their maturity window clean. And there's a cost to that. And actually take that upfront cost in earnings. So the earnings could be higher if they didn't do that. But this is a decision that they've taken. And as a result, the way we describe it is this is a masterclass of how a CFO should manage a balance sheet. And I think it de-risks the equity story substantially. And it gives them time to de-gear. And I think the flip side of it is what people miss is healthy, good balance sheets are good. And in general, we'd agree, but there's also value in de-gearing. There's a debt-to-equity transfer that happens as a company with a strong moat, strong cash flows, and a recovering story after COVID. As those cash flows emerge and they pay down debt, that's a transfer from debt to equity in the enterprise value. And that's incredibly powerful. So you've got a number of drivers that are, I think, driving equity returns for us over the next 3 to 5 years. So we're incredibly excited about it. As you can see on the table, it's a reasonably new investment. We had a bit of it last year, but we actually sold most of it out. And at the beginning of this year, in the Balanced Fund, we didn't have any, very little. So this is a share that we were very active on in March and April. So we, with all the pain that COVID brought, I think it also brought some opportunities.
Well, I know as a South African, I'm doing my best to help that share price at the moment.
Thank you.
Especially since we've gone to level 1. Okay, there's another share that piques my interest here, is JSE. And I read comments that say there were 700 shares 3 years ago, whatever the number was, and we've got 350 shares left. It doesn't strike me as a company that's going to make me money because its market's contracting.
Yeah, it's a very interesting investment thesis, this one. So I think a couple of points. One is just for the benefit of the audience, what is it that they do? Most of their revenues are probably about half are equity trading. And we've got a very big equity culture in this country, always have had. And I think that has been a key part of their revenues. It can be quite cyclical. So as we've seen, they're going to go through years where it's very good. 2018, 2019 was quite painful. It came down. Looks like this year is going to be excellent again. So this is a company that is actually benefiting from some of the volatility. But it is a reasonably cyclical part of the revenue mix. It is true that the markets are gradually de-equitizing. So I think it's a trend you're actually seeing globally. It's not unique to South Africa. So you're seeing the number of listed companies shrinking. And there's a number of drivers behind that. Some is just consolidation, companies buying each other, becoming bigger. Also, companies realizing, particularly smaller companies, that just the regulatory hassle of being listed is just not worth it. And especially if you just become ultra illiquid, I mean, it's kind of no point, right? So you're seeing this delisting process that's kind of happening over time. But the important thing to realize is, 99% of their revenues is earned in the top 100 companies. So them going from 700 to 300 seems like a big deal, but if you're making 99% of your money off the top 100, I mean, there's room, it's not as big as it might seem.
So I guess not a lot has changed then, really. It was top 100, it's still the top 100.
Exactly, it's not the top 100, and most of their revenues are coming with these very big dual-listed shares, actually. So benefiting from some of the cross-border trades. And I think there's opportunity for them to do more of that. So the management team is thinking about links with China, getting the Chinese traders so they're doing this trial where actually giving free data to some of the Chinese exchanges, and that you could result in some extra trading from that as well. So I think that they're trying their best there. I think the key thing to point out, though, is this is a business model that is one of the highest quality business models globally. And the kind of the analogy we like to use is it's effectively a toll booth on the equity market and on financial markets, capital markets globally. And if you look globally, these type of businesses typically trade on 20 to 30 times earnings multiples, PE multiples. They're very cash generative, and JSE is no different. They pay out all their all their earnings in cash, very big dividend. Very strong balance sheets. They don't need gearing. They actually net cash. So this is a company that is net cash. And although they net cash, they're still earning ROEs of almost more than 20%. So these are high quality business models. But because of SA Inc. and because of some of the macro fears, it's available to us at 11 times earnings. So this is one of the cheapest stock exchanges.
11 times earnings.
11 times earnings.
Okay.
8 or 9% dividend yield.
So did you just say 8 to 9% dividend yield?
Correct. And we actually think
a company that's actually going to have a dividend.
It's actually going to have a dividend, and it's going to grow this year as well, because this year's actually been a reasonably good year for them.
Okay.
I mean, this is an example for us of companies that, we often get accused of being, of having a macro play on. SA Inc. is the macro play. We're just blind to the risks out there. We are as concerned as everybody else about the deep structural issues in this country. They are very real, very challenging, and I think very uncertain how they're going to play out. But within the SA Inc. universe, you've got a lot of variety. You've got companies that are actually a lot more resilient and whose earnings and cash flow drivers are actually a lot more decoupled from SA macro than you'd think. And I think this is quite a good example of it.
Justin, that kind of brings me to my next question. Okay, so I look at South Africa, and it's scary to even listen to the radio, put the TV on at the moment, and most SA managers are saying, look, just avoid SA shares, just stay away from domestic Inc., stay away. And yet you guys are investing in these. My question to you is, and it might be rude, are you optimistic, naive, or a believer in mean reversion? I mean, why on earth are you buying these companies? You gave them the JSE as a good example. Perhaps you give me some more examples, because I look at this country at the moment and I'm pretty scared.
Yeah, no, that's a great question, and I think I'd probably start off in answering that with a couple of points, and this would be the first one. And I think the first one is just an observation that if you look back in periods of time, and this is just looking at South African data, but you'd see a very similar thing if you look globally as well. And what this chart shows you is the Business Confidence Index, which does a pretty good job of just tracking business confidence and just general confidence in the economy over long periods of time, going back to the 80s. And I think what you can see is if you look at kind of low points in that cycle, and there's kind of 4 that we point out. There's 93, 98, and 2002, and then obviously March 2009. And they each had different reasons behind them, kind of different concerns. Some of them were domestic issues, some of them were global, but all of them had reasonably low confidence. That was kind of the common theme. And what's quite interesting is if you look at a basket of SA shares, and what we've done here is just to show, there's 4 shares that have been listed on the stock exchange for a very long time, and they're all reasonably South African economy focused. So AVI, Standard Bank, ACI, and Hudeco. So if you just look at that basket and how they performed in the 3 years subsequent to those low points, they were remarkable. So it's not obvious. It's actually quite surprising. You'd think buying those shares at that point would have seemed very, very risky. So that'd be the one point, is from times of low confidence, your returns can be very, very good because markets have this habit of overplaying, of getting too fearful, and of making too much pessimism into share prices. And so when things normalize a little bit, actually, some of these shares can do very, very well for you. Now, we're in a situation now which is probably, an order of magnitude worse than those times, right? Mm-hmm. So I think there's no dispute about, from us, we've got higher debt levels as a country, Eskom's a mess, we can go on and on. But what's quite interesting to us is I think a carefully selected basket of shares where there's intrinsic competitive advantage that we think the market is missing, and where they're managed by conservative, high integrity management teams that allocate capital in a judicious way, we think you're going to do very, very well. So that'll be the one point, is history suggests there could be opportunity. It doesn't guarantee there's opportunity, but it suggests there could be opportunity. Now, if you look about what we do practically, that's a bit of a top-down analysis. We'd be looking at the actual individual companies and saying, how geared are they, or how reliant are they on the South African economy? Some of them are more than others. So we'd be looking for companies that have either some sort of competitive advantage that protects them from that, and the JSE is a good example of that. I think Discovery is perhaps another one. And the other thing we're looking at is companies that perhaps have offshore businesses that are ignored or underappreciated. And we've got companies there like Imperial, Supergroup, where they have substantial offshore cash flows, very substantial. But they're traded and they're valued as if they are a disaster basket case SA company. And we think those type of opportunity gives us quite a lot of hope and excitement.
Okay, well, nice to know there's some hope and excitement, but I think when you and I have chatted before, Justin, you say you're a realist, not an optimist, because I think you have to be aware of what we're dealing with in South Africa. So that leads me to my next question. Property stocks look fantastically cheap. Is that a mirage? What are you thinking?
Yeah, listed property. Geez, what a journey, eh? What a roller coaster for.
It's been great for the guys who've shorted it.
Yes. So this is quite a good example of, and we would use this as I think evidence for how we are not just blind value managers closing our eyes and buying stocks with low price to books. That's not what we do. And the background here is we've had no exposure to listed property in South Africa, and I think that's benefited our clients. Where are we now? I mean, without a doubt. And what are the reasons for that? I mean, there were a couple of reasons why we were concerned. I think the REIT structure in itself is reasonably inflexible, and it was our observation that companies were distributing too much cash. They were looking for non-recurring methods of distributing it. They were using debt too aggressively, and they had a habit of, which is probably pretty rational given their share prices at the time, of issuing equity like it was nobody's business, right? So those were kind of a couple of things that got us worried. And then additionally, you had a big supply side issue where a lot of supply, particularly in retail and office property, was coming into the market over many years. And I think in combination, the problem with property is it doesn't disappear very quickly. So you build a hotel or an office. What do you do with it when people don't want it anymore? It's kind of there, it's stuck, it's tangible. So it becomes a bit of an enduring supply side problem. Now, we didn't forecast COVID, so I think we can't take credit for that. But that's what that's highlighted is the fragility of the system. It was fragile already, and when an external shock hit it, there was nowhere to hide, and the entire sector just got crunched. Now, where are we now? We actually looking at it with quite a lot of interest. I mean, our process gravitates to pain, and it's probably the sector with the most pain. But
our process gravitates towards pain.
It gravitates towards pain.
That's a lovely expression.
Yes, apologies if it seems a bit too sadistic. But we think that's often where the best opportunities are, is when there's pain and when there's fear. And if you can buy underappreciated quality, you don't buy everything, but if you can buy, if you targeted and specific, well-researched, and you buy well, we think you can do very well. So we're in that process at the moment. I think it's probably too early to say where we'll come up, but I think a couple of things still worry us. One is the debt levels are extremely high, and there's a bit of concern that the REIT structure forces them to distribute cash, so they're not able to retain as much cash as they would like in order to naturally de-gear. And this is happening at the same time as values are coming down. So the asset values are falling, debt levels are fixed, and they've got covenant issues with the banks. So we think it's probably the sector with the highest share count risk that we see. Some of them will escape, some of them will be fine, some of them will be very good investments. So I think it's probably fair to say that we we're looking at it with interest. We're probably nibbling a little bit in certain what we think are the better counters. But I think it's probably still early days. I do think it'll be a good opportunity. Certainly over the next 3 years, I think you'll do well at some point buying the right companies. You might want to buy it at a better capital structure, though.
Justin, a question for you that has to be asked. Okay, so forgive me. You don't invest like the herd. We talked about momentum at the very beginning of this conversation. You're not buying the few stocks that everyone's chasing. But obviously, because of that, performance has suffered. How do you think you get this performance back? And what is the benefit of having a contrarian mindset?
Yeah. Oh, thanks, Joanne. It's been very disappointing to us how we performed this year and last year in combination. And I think, it's not something we would have aimed to do, obviously. But I think what it does is it highlights a couple of important points. One is we have a natural process of being very different. And we're very comfortable being different. And that is in itself a very uncomfortable feeling. I think the natural institutional imperative is to look more similar to everybody else. Mm-hmm. And that's something we've tried to resist. And it's paid very, very good dividends to our clients over many, many years. So this is a process that has worked. And there's been years when our clients have done very, very well because we've been different. Now, one of the consequences of being different is that sometimes you'll look really stupid and really wrong. And I think that's kind of what the last couple of years looks like. And I think what we would say is a couple of things. One is, when we look at it, most of the drawdown and some of the share price volatility that has hit us is likely to be temporary. We see very little evidence that we've locked in permanent capital loss. We've made one or two mistakes, particularly last year. So we had an investment in Tongaat, which I think we'll see what happens there. But I think that's largely going to prove to be somewhat permanent. But in general, most of the pain that's visible in the performance numbers recently, we think is temporary, and we think has already started over the last few months to start to turn for the better. So that's just the one point to make, is it's important to distinguish between permanent and temporary capital loss. The other one is when you're as different as we are, and then you have an external shock like COVID, which almost magnifies this kind of two-tier market, and we finding opportunities in the bottom, and the top kind of gets this extra boost up. It's going to look quite painful, but what it does do is it actually increases the probability that you'll do better in the future. So I think that what I would say to you is we are determined to consistently apply our process. There's been no change to process. We're trying to be patient. We're disciplined. We're being pragmatic and flexible. So when things are changing, we do change our minds if necessary, if competitive advantages fall.
Do you have any women in your team? It's not like men to change their minds. You know that men are quite inflexible.
Not enough. So if you know any, please send them our way. But okay. But we do have some women in our team.
So you do change your mind.
They make a great contribution.
Nice to know. Okay, yes.
And I think that the last point I'd make is we'd look at portfolios today, and I'll just use the Balanced Fund as an example. There's three kind of broad pockets, right? So there's SA equities, which we've kind of touched on now. There's global equities, and then there's kind of the fixed income and cash assets. Each of those three pockets, we're looking at probably unprecedented returns from this level. The differential between the price and our assessment of intrinsic value, even with a COVID hat on and adjusted for COVID, so many of them have come down from what they would have been previously, is the highest it's ever been in all three buckets. So you've got this very rare phenomenon where you're very different from the market, but your indicators are flashing opportunity. So when will that come? I wish I could tell you. I'm afraid I'm not qualified to predict the future in that sense. But I do think we're quite excited. I think it's certainly on an appropriate time horizon. We're looking forward to the future with a lot of confidence.
Okay, Justin. I'm going to see if there are any questions from the audience. Do we have any questions coming through? Because I feel like I've monopolized you for the last 35 minutes. Here's one for you. Glencore, you've been holding that share for a number of years. Why is it lagging so much? And also to that, management at Glencore, given an ESG factor, are not known for being particularly governance friendly. Perhaps you want to talk to that.
Great. No, fantastic question. So, there's a couple of reasons why we like Glencore, and then I'll touch on why we think it's been lagging as well. So the main reason that we like Glencore is the mix of commodities that it's got is quite unique. And it's got no iron ore, which we think is a good commodity, but it's the one commodity that has done really, really well. So, when we're looking at margin of safety and opportunity and kind of normalized levels, given what it takes to actually produce and transport that economy, there's not a lot that excites us about iron ore right now. So there's actually few diversified miners that don't have iron ore. All of them have it. Anglo's, Billiton, Rio Tinto, Vale. I mean, they've all got stacks of the stuff. So this is one that the lack of iron ore is intriguing to us, and it's been painful because they didn't have iron ore. That's driven the other guys up. Okay, so that's the key reason probably for the underperformance. The other one is, what do they own that we like? They've probably got one of the best portfolios of commodities that are geared to this green revolution. Now, it might surprise you that we're not kind of thematic managers and looking for the next best thing, but I think we are aware of the fact that renewable energy is going to be a structural growth area for many, many years. I think there's a lot of good reasons for that. And what people miss often is, in order to electrify the world, you need some very important commodities, and they come from the ground. They don't come from thin air. And there's copper, there's nickel, cobalt. You could go on. And I think Glencore's got a fantastic portfolio of low-cost assets, which they understand very well, which we think haven't benefited them yet, but over the next few years, it's quite a nice option to have, particularly in a world where, if inflation comes back and you get a bit of inflation and real assets come into favor, you have a weak dollar. Again, we're not macro specialists, but if that happens, those assets will do very well. Then the last thing we would say is they've got a marketing business, which is very different. None of the other guys have it. And this is a business that actually performs very well in terms of market dislocation. And you actually saw that now in the first 6 months. This is a business that I think they've had their best 6 months ever, because they were able to buy oil when it was negative. Remember when those WTI futures went negative? They were buying those things, or I don't know if you're buying a negative, I don't know how that works, but anyway, they were exploiting that and then delivering it later because they own the logistics.
Getting it for free, essentially.
So they made a lot of money, and I think this is quite a nice, it's actually a high value asset, which is kind of almost buried in the belly of a commodity company, which is undervalued, we think, and I think will prove the test of time. So that's a couple of points about the portfolio. Management's incredibly important. Okay, now they haven't done themselves any favors, and I think we would wholeheartedly agree. But I think it's important to realize a couple of things. One is that no one is more incentivized than them to get this right. So this is a company that has enormous insider share ownership. So Ivan Glasenberg and the guys, they own a substantial stake of that business. This is their legacy. This is what they do. So no one is more incentivized than them to get it right. And you're seeing the evidence. A lot of the issues that are still being discussed today are older issues. They weren't acceptable then, but a lot has changed. I think they've made a lot of effort to improve. So when we're looking at kind of governance and management and the ESG angle, it's incredibly important, but we want to see proof of change. We want to see, the journey, the steps taken to improve. We're not going to throw people out because maybe they did something bad in the past if it looks like they're improving. So that's something that we think helps mitigate that. And at the end of the day, this is a company that could double quite easily. So that's probably the most exciting.
Double sounds good to me. Okay, back to South Africa. And yesterday's unemployment numbers were a complete shock. Coming out, I think, at 42%, if you're ignoring stats, South Africa's ridiculous numbers, so 42%. How do you think that's going to impact some of the stocks you hold in your portfolio in terms of, consumer spending, the impact on taxes, etc.?
Yeah, that's a very concerning statistic, and I think it's exacerbating what has always been of deep concern to us. So this unemployment and inequality that we have as a country is not new. It's been around for a while, and it's not good. So I think that's true, and I think it's no surprise to us that COVID would kind of almost be another dagger in the belly of that problem. So it's a bit heartbreaking. The people most affected are often the ones least able to cope with it. So there's a dispersion of outcomes. Typically, people who have savings are better off, are actually more resilient, and are less affected. So it's a bit of a human tragedy. I think looking at it as far as the economy goes, I think there's a couple of things to point out. And I think that's the importance of being quite targeted and quite specific about which SA Inc. shares you own. I think if you look at our portfolio, there's a couple of areas that we're actually underrepresented in. We like SA Inc., we think there's a lot of opportunity there, but two big areas that we're probably a little bit more cautious on than some of our peers would be retailers and banks.
Okay.
And I think those are probably the two areas that are likely to take the biggest hits from this type of thing. It's discretionary consumption, and particularly if you have high margin retail with a fixed cost base, it can get quite painful for you. And then banks, if you got a retail franchise and people, once the payment holidays come to an end, they're providing like crazy, and we hope that'll be enough. But that's where the pain's going to come. It's going to come from that.
I saw an article somewhere today that said the number of people who can't pay their mortgages in South Africa has came to all-time highs or something like that. Yeah. So I think banks could be in all sort of pain. Here's a more positive question. The next bull run can potentially be driven by the Chinese consumer. Do you have any shares that will benefit?
Yeah, Chinese consumer. Hey, where is it going to go? I think the one that probably point to the most is Discovery. So Discovery's built they partnered with Ping An to build a healthcare business from scratch. This is another, again, many of all their businesses, they start from scratch. They do very little buying. And they've done a remarkably good job. Now this is a business which it's linked to the consumer. The consumer buys healthcare. The interesting kind of dynamics about healthcare in China is that it's largely been a self-paying business. So there's not a lot of kind of public support, and there hasn't been a lot of insurance. So this insurance is kind of this nascent market, but it's potentially an enormous market. So the modeling we've done suggests that this could be orders of magnitude bigger over the next 5-10 years. It'll be a steady progress. So that's probably the one area that we think is completely underappreciated in South Africa. You've got Discovery is often treated as a complex SA Inc. life insurer. And what people miss is they got this gem in the business, which similar to Tencent. I'm not saying it's the next Tencent, but we would say it's got a similar dynamic. It's small. They've got a minority stake. They own 25%. But this is a business that could be bigger than the whole of Discovery put together in 5 years' time.
Justin, I'm picking something up from you today. You talk a lot about people missing things. It strikes me that you clearly do a lot of research on companies. You've mentioned it quite a few times today, whether it's JSC, whether it's Glencore, whether it's Anheuser-Busch. So nice to know, because my last question for you, it's not your job to tell advisors where to put their money, but clearly you're doing things quite differently. Why should I have PSG Balanced Funds or PSG Equity Funds in my portfolio today?
Yeah, so it's an interesting one for us. I mean, when I look back and look at it, the last few years have been challenging, but I would remind the viewers that the track record and the process that we've delivered over long periods of time has worked. So this is something we've got confidence in, and we think they should too. So we think while it hasn't worked recently, it has worked over long periods of time. Then the second point is hopefully I've made my case well that we think there's a lot of opportunity just from a return perspective.
You did mention Glencore doubling.
Well, I think that's not the only one. I think we wouldn't be surprised if we're seeing a lot of doubles in our portfolio from these levels. And we've got no idea of the time horizon, but we think that sets us up pretty well. The importance of differentiation is critical. We've been hurt and we look a little bit silly because we look so different to everybody else. But that's an incredibly valuable thing. For an advisor to consider when they're considering a number of funds next to each other. So we would highlight that. We think we're different for the right reasons. We're not being different just for the sake of it or for a selling point, but we think we're different for the right reasons and because we think a little bit differently as well. We try not to be arrogant about it. I think there's a lot of smart investors out there that disagree with us on a lot of things. So I think we're trying to take a humble attitude to investigating where we're wrong. One of the things we love doing is trying to seek out the bear case of a lot of the stocks that we own and to look at them in a lot of detail. So this is kind of a key part of our process. So I think put it all together, I think we're at a junction now where the last couple of years looks horrible, but that's always going to be the case just before a very, very good run. And I think it's always hard to believe because the natural behavior is to extrapolate the most recent past. And we think the opportunity is to look forward And we think we bring something different and something valuable. So we're very excited. The thing that probably keeps me up the most at night, it sounds a bit silly perhaps, but is that some of our clients might miss this. I think a lot of our clients, for good reasons, have given up on us. And we think that would be a tragedy if they didn't hold the line for just a little bit longer.
Justin, thank you very much. Thanks everyone for attending the feedback session with Justin Fleur. I hope you found it insightful, and I certainly did, so I've learned lots today, and you've enjoyed the Q&A format. If, however, some of your questions were sent through and they haven't been answered, a PSG investment specialist will get back to you and answer it shortly. And please don't forget, this is liable for CPD points, provided you answer the Q&A session. Enjoy the rest of your day, and we look forward to hosting you at our November summer update. Thank you.